September special edition of the Wealth Workshop. I am with Jacob Radke, partner at Fiel Capital. My name is Tom Statham. We're so glad you are here. We're going to be talking about the markets right now, the current state of the markets. There's been a lot of interesting deals announced. Actually, some really interesting deals. We're going to be talking about Oracle's $3 billion OpenAI AI deal. We're going to be talking about NVIDIA's investment in OpenAI, $100 billion. We're going to be talking about the economy, the jobs market, the Federal Reserve just cut rates. So, Jacob, welcome.
Hey, thanks. Yeah, it's kind of crazy how much stuff is happening with OpenAI.
I know. I don't know if you've thought about this, but what seems to be happening in the chip space is it kind of reminds me of like when you're fishing and like when the fishing line gets all spooled together and it gets all and you get like a rat's nest. Is that what they call it? Or is it a rat's nest or a bird's nest? What happens when the fishing line
Yeah,
gets all
yeah,
tangled up?
yeah. A rat's nest. Yeah.
Rat's nest? Okay. That's what I feel like's happening in the chip space right now. It's hard to keep it
Everybody's
all straight. Everyone's
everybody's just
investing in
kind of
each other.
yeah. Because I think the funny thing, and we can jump to this if we want to, but the $100 billion investment in OpenAI from NVIDIA is going to buy advanced GPUs, probably from NVIDIA. So it's like NVIDIA paying itself for its own GPUs.
That's what I thought as well. And then you have
Which,
NVIDIA buying
yeah,
Intel. The US government is staking Intel. Um, the US government was taking 15% of Chinese revenue from NVIDIA.
Hmm.
Microsoft owns, is it 50%? I think it's 50% or is it 51%?
I think it's like 49. They don't have the
For
majority, so maybe it's 50% or 49. Either way.
49% of OpenAI, but it's the IP. So this like the hyperscalers, right? Actually, these companies beyond the hyperscalers. So you got Microsoft, Meta, Google, um, NVIDIA. These are all like these companies are the companies that are driving the market higher, and they're all investing these massive deals. I think because they have to work together because they have no other choice, right? Like there's only so many people who can provide the infrastructure or have the cash to meet the demand. Um, I do think this is one of the more interesting storylines playing out for investors, or like what this
Yeah.
means in 5 years.
When you wrote about it last week and tomorrow, well, I guess you kind of wrote about the $300 billion Oracle deal with OpenAI, which I thought was really interesting that they won that contract.
Yeah, and in the article in the edition, I talked about how like OpenAI had to go OpenAI had to go to one of the losers or like the air quotes losers in the cloud space because if they sign a deal with Amazon, Google, or Microsoft, so those are like they have like 2/3 market share in the cloud computing space. Like if they partnered with Microsoft, now granted Microsoft owns part of OpenAI, which is confusing, but Microsoft is building out Azure, or excuse me, their Copilot product, which basically is OpenAI. It like if OpenAI went to one of the big three cloud providers, they would be giving that cloud provider liquidity and financial horsepower to reinvest in their own AI business, own AI adventure, or not adventures, their own AI products.
Yeah, they can just reinvest into like their own competition, right? OpenAI doesn't want to go in and say, yeah, here's $300 billion over the next 5 years, Google. And then with that $300 billion, you can go and like invest in Google Gemini and put that into our search browsers and like whatever they end up doing with it. Where Oracle, they don't really have that necessarily. Like
Yes,
they do have their own AI products, of course, but they're not quite at the mass scale that Google, Microsoft, Amazon are with those other huge cloud providers.
it's so fascinating. I mean, seriously, I think what's going to end up happening is NVIDIA is going to own Intel.
The entire thing.
Where else is this going? Like, I feel like Intel, the US government, and NVIDIA are like they've all like decided to do business with each other. Well, I don't think by choice. I just wonder if that's where this is headed.
Well, I mean, if you think about it, NVIDIA is a $4.5 trillion business and Intel's what, 50 billion? Like
Mhm.
I'm pretty sure Nvidia makes in just cash flow the market value of Intel in like 1 year. So
Mhm.
theoretically, it's not that hard for them to just LBO Intel and bring it
Yeah.
into Nvidia. Now, the thing, of course, is like then Nvidia would actually have to be successful in creating a U.S. foundry business, which is really the long-term play with Intel and why the U.S.
Yeah.
government's investing there. Because of course, like all of the advanced chips are manufactured in Taiwan right now. U.S. government, Nvidia, and of course Intel all wants that to come to the United States.
Yeah. And this as like from an investor, right? Where when these big companies are just increasingly running into each other and the US government, it does make me wonder like what's the end game here? And not that we necessarily need to find an end game per se, but it is I will just say it's odd. And these are like huge deals. And we look at the profit margins of these companies too, like how much value these deals unlock. It is just striking.
Yeah. I heard an interesting breakdown of like the Oracle deal. Are you familiar with the guy? I think his name's Dan Nathan.
No, don't
He
know.
he has a podcast called Risk Reversal. It used to be called something else, but I can't remember. He just recently changed it. Anyway, I listen to it every now and again, not super active listener, but he was like, I don't understand why Oracle jumped like $250 billion in market value after this. And his essential like theory was Oracle doesn't have the infrastructure, so they're going to need to build out this infrastructure. And they
Mhm.
probably got the lowest bid because if Google came in way lower than Oracle, like of course OpenAI is like, well, if we can save 50 billion, it's worth it. So they probably got the lowest bid, so they're not going to get the most amount of money to go and build out all of this infrastructure. So they're going to have to go into debt to do it. And he was like, "Are investors just not looking at the math of this deal?"
I think what investors are looking at is like what comes next. That's what I think.
Yeah, I mean, is this compared to Oracle's existing business of like, well, you're not really in the lead.
Mhm.
This is more promising for the future of Oracle than what they had before, but it's also like it introduces a new level of risk.
Yeah, it's fascinating. So what's the end game here?
It's really hard to say. It's really hard to say. All of these AI companies, like OpenAI's, I think Sam Altman himself said that OpenAI is in a bubble, or AI is
Yeah,
probably in a bubble.
yeah,
You're writing, or maybe this was no, this is in our we write a quarterly market letter, and you're writing in there that like all good investors know that good times eventually end,
yeah.
right? I mean, we just watched Nvidia go up 1,000% in the last 5 years. I mean,
Mhm.
that's insane. I think Broadcom did the same thing.
Yeah,
Be just like what actually happens next because like you can't just invest $300 billion over and over and over and over again. Eventually the money runs out.
yeah. So what's
And
crazy about this is what my understanding of what's happening right now, what's actually happening in the marketplace is this is a race to win the consumer.
totally.
So like what's happening, all these deals are to win market share of people. And from that place, like OpenAI will like the play is like B to C to B, I guess. So business, yeah, business to consumer to back to business. And so at like that's what they're investing in. Like the Nvidia Intel, that's obviously infrastructure. So the money's still in infrastructure, but OpenAI, what that is obviously is just a land grab for the consumer market. And um, and then from that place, they'll lever up and create some like massive B2B play, right? And enterprise software. I guess if it's even going to be software, it'll be software, right? Um, and that end game is who knows how that's going to play out.
Yeah, the biggest question mark is like how is it actually monetized?
Hmm.
It's like they're like before Google actually figured out how to monetize an indexed internet, like it was kind of just like all over the place, right? Google
Yeah,
just figured out how to like, oh, we index it and we can put ads in here, and they did it really well. There'll be some form of that comes out of these businesses, and it won't, and all of them won't figure it out. There's going to be a handful that actually figure it out, and probably one that takes a big chunk of the market.
I wrote this week that or just in the first edit of the newsletter that um, had we not, and we'll get into the Federal Reserve in a second here, but had we not had AI happen in 2022, the market I wrote would not even be remotely in this like remotely close to where it's at today.
Oh, totally. Yeah, totally not. Yeah, it really did help like drive a story and a theme and
Hmm.
a spending boom, right? Like the theme that we're writing about, to our clients, like the thing that we're watching is like the amount of spending worldwide that's just happening is incredible. Whether you've
Yeah,
got whether you've got like the Japanese or the Germans that are just like, we're just gonna issue, billions of dollars in debt and reinvest it, or
well, I
OpenAI
think
is.
that I think that would have still happened. So had AI not happened, like the Germans would still spend money. Like Trump would still be president. Therefore, inflation's. But the if AI, like if Oracle didn't get a $1 billion deal with OpenAI, like there's not a single chance that Oracle would be a $1 trillion company today.
No, no, yeah, yeah.
So that's what
I'm
I'm
with you.
saying is like where like had and I think this is a really interesting question for investors to ask because we've just talked a lot about it. We've talked about why like just the tangled mess that is the hyperscalers, like how they're just bumping into each other like crazy. Without that, like what is the stock market? Like what's driving growth, right? I can't remember who said it, but like software, I think this was in the All In podcast. One of the guys was saying how, software was dead, like it just wasn't growing.
Oh yeah, yeah. And then you look at Salesforce and Adobe, and
Hmm.
some other of the like the big software companies, and their sales are flat or declining this year.
Yeah. So I think that's like the question for investors, and obviously we're talking about this in our investment committee meetings. Is like if we didn't have AI, like what what drives the market higher? It ultimately doesn't matter, right? Because like the AI story is going, but
And we've got it.
yeah, we've got it. But if the good times do end, where's the money? What's going to be propelling stocks higher?
And you know what it ultimately could have been too. Like, if AI didn't come around, the chances that we were entering into like, an employment shortage, or a more of like defined recession at the end of 2022, like the Federal Reserve would have maybe jumped to cutting rates way faster. And like that would have been the story of
Yeah.
like 2023 and 2024, would have
Yep.
been like a more like liquidity event in the fixed income markets, in the real estate market, that would have helped propel some of the growth. That could have been the ultimate story that actually came home if AI didn't happen, or like that,
Hmm.
November OpenAI ChatGPT announcement didn't happen.
Something that I saw this week, and I hadn't seen this in so long. I almost wrote about it today or this week, but the amount of money still in money market funds. So we
Yeah,
were telling
it's not
clients this a
moving.
few years ago, yeah, that money market funds are at, I think they're pretty close to all-time highs. I believe what I saw over the weekend was $7 trillion or so in money market funds, and that that money will go someplace, right? Everyone's like holding, not everyone, but lots of people are just holding out in cash, just given their maybe personal views of the world and the fact that you can earn basically risk-free 4 to 5%, which is pretty good, right? So I think an interesting dynamic here is like the stock market is ripping, right? And so the stock market's ripping higher. The we're at all-time highs. I mean, I'm shocked like every day when I open up my phone in the morning and I check the stock market, see what's going on. I'm like, wow, this is the momentum is incredible. And the money market is still at all-time highs. There's still $7 trillion that must go someplace at some point.
Yeah. But it's also money market funds as a percentage of like the equity market is definitely low. But it's still like there's still trillions of dollars, and if that was to move somewhere else, that would be significant.
I think this is going to be the play as the Fed lowers interest rates. We'll see what this cut cycle looks like, right? We'll see where they actually land. But does that money move and where does it go, right? and I think it would go back into my guess would be the fixed income market, maybe.
Yeah, it'd probably be the driving force of lowering the longer term fixed income yields.
Mhm.
Like over time, like the yield curve to more like flatten it out.
Yeah.
But I mean, people's equity allocations are also like they're high. Like I
Mhm.
don't I can't cite this specific survey, but one of the podcasts I listen to, they always talk about how 401k equity allocations are like at all time highs, like
Which doesn't
highest.
surprise me at all.
Yeah, I mean, especially given through what we went through the last like 15 years since the GFC, 0% interest rates. Like, what's the
Yeah.
point?
Well, I think like 401k, I mean, people just don't care. Or they don't know enough. They deeply care about their 401k. I guess maybe I misspoke there. But if they're in the target date fund or they haven't changed their allocation in 5 years, like not surprised by that at all. But
No.
the amount of money market and where that money goes and does it go back into fixed income markets? Does any of that go back into the equity markets? Uh, who knows, right?
Or what about if it goes into real estate? Like
Or real estate, yeah.
if mortgage rates start coming down and like the buyer activity starts picking back up, like who knows, maybe a few trillion flows into just residential single family homes.
Yeah, yeah. This is such an interesting time to invest. I think this is with the momentum in the short-term momentum in the equity markets, the the fixed income market, I think is really well positioned right now. Um, Given what we just talked about, I think the asset class that's, for what it's worth, that is probably like the least exciting, not least exciting, I shouldn't say that. The least attractive would just be cash.
Yeah. Yeah. Well, between like cash, fixed income, and equities.
Yeah. Well, even real estate's,
Oh
gone
yeah,
sideways. The outlook for cash right now with the Feds dropping, it's just objectively, it's like if you're getting 4.25 on your money market fund, well, you'll be getting 3 in a year.
yeah. Or I mean, or who knows more? It could be more, it could be less. But
Yeah.
I'm with you. Yeah, the like even in just like municipal bonds, somebody investing in 1 to 10 year munis, you can just get way better tax advantage yields. Now, of course, you're introducing some interest rate risk, but like
Yeah.
if the short end rates are falling, there's just a greater likelihood that the long end rates are too.
Yeah. I think the backdrop for investing right now is just great. I know it
Yeah.
doesn't necessarily feel great, but when you look at what the Fed's doing, I didn't get to writing about this, but I wanted to. The Fed cut cycle. So they cut in. Um, they started cutting, I believe, in 2018. The next cycle was, or excuse me, hiking. So they cut in 2020,
Hmm.
um, and then they're cutting now. And these last two cycles, right? So those are the last two cut cycles. Um, they're just wildly different, right? Like the reason why they're cutting in the reason they cut in 2020 was well, if the government shut us down, they had to bail us out, right? So they dropped them to zero pretty much instantaneously with COVID, right? And then this cycle, though, it's just different. And I don't think these types of cut cycles are um, as common as the emergency cut cycles of 2020 and 20 or the GFC, the financial crisis. So um the so it's just I think the backdrop because of how they're cutting here is good for investors.
Yeah, and I think they have good reason to cut too. I mean, we did have higher inflation. It's ticking,
Hmm.
it's up just a little bit, but it's been relatively stable. And
Yeah.
the big red flag, of course, is there's 22,000 jobs created in August,
Yeah.
and out of how many people work in the United States, millions of people,
Hmm. Yeah,
and
170
they
million or something.
yeah, yeah, and then they revised the actual job growth by almost a million positions downward, and so there's
Yeah, for
notable.
2024.
Yeah, there's weak sentiment in the labor market, even though there's still like a little bit, like there's still a little bit of inflation. So there's a really interesting, like, they have good reason to cut interest rates, is what I'm saying.
Yeah. So what does somebody do right now? So like, what would be if somebody came to you and be like, "Hey, I'm retiring in 3 years. What should I be doing with my money?" What are you telling people?
I mean, the most like I think what we said at the beginning, like, well, and what we're saying in like our letter is eventually, if you're average decent investor, eventually the good times end, and the
Yeah.
equity market has just been on a really, really, really strong rally. So there's reason to like go slowly and not like, if you're rolling over a 401k into an IRA and like reinvesting the whole thing, like how much do you put to equities? I would honestly, I'm sitting on the conservative side of like, well, let's just be careful about how fast we allocate to that space. So that's the biggest question, of course. Like, you don't want to put too much into bonds because you don't want to run into inflation risk or longevity risk of like running out of money. Like, that's a
Mhm.
huge risk in and of itself, is not taking enough risk, but you don't want to take so much risk that you face like the sequence of withdrawal risk. Like, year one, the equity market falls 20%, and now you're like, I still have to take $100,000 out. So there's
Yeah.
like that balance of like, how much liquidity do I have for the first couple years? Like, match it to spending, put that at least in the fixed income and cash bucket,
Yeah.
and then from there start to decide like, this is what my equity position should look like, at least until the balance grows to a sizable portion. Of course, everything's through a lens of financial planning.
Yes. I'm bullish on the equity market right now. I think the backdrop is good and interesting, and it is always a little scary when the IPO market is flying, you know?
Yeah, yeah,
And like that to me is always like, yeah, just makes me concerned, right? When investment banks are going and they're ripping higher, uh that that's always like, okay, we're getting over our skis. With that being said, so that to me is like, okay, let the good times roll. But uh I just think the backdrop is interesting, and whatever happens, from here, like it'll go fast. Like I'm just convinced like the market is just permanently moves faster, and being prepared on your really like on your tactics, like your management tactics. That to me is that's what I would tell somebody. It's like, hey, enjoy the equity run. Understand that the fixed income market is probably going to be pretty good. The black swan, like what trips people up, we don't know, but whatever happens will happen fast, and so be prepared. Did that make sense?
yeah, and yeah, I would say that I'm generally pretty bullish on the equity markets as well. Just with like I think there's just reason to be cautious, but then there's also like the reality is like over the last 5 years, the S&P 500 has been up 100%. So
Yeah.
not getting that is just as bad as avoiding like a 20% drawdown, right? So
Hmm.
yeah, and I don't know if did you see the chart that I had put out? This was maybe 3 or 4 weeks back, just showing like the cumulative inflation over the last 5 years and the cumulative S&P
No,
500 performance. It's shocking. That is 25% is what the inflation. So things are 25% more expensive on like
in
a
the last 25
broad
years.
broad
Wow.
5 years, 5 years.
Yeah, 5 years.
Um, that's so like whatever. Your Yeti mug is 25% more expensive, but if you just owned a Yeti mug worth of equity in the S&P 500, it'd be worth 100% more.
Yeah. Yeah.
So like that's like good thing to keep in mind. It's like you're
If you were
building these
to
portfolios.
if you were to overlay the fixed incomes return, like I did, I was looking at TLT. I think I put this in. This was maybe a couple weeks ago. I put in the TLT's cumulative return, and it was so bad. So that's like long term treasuries. So you've had just like, I mean, bonds have been awful performers over the last 5 years, like negative compounding while inflation is ripped. So like the spread there has been just like really, really damaging for conservative investors. What's great though is folks heading into retirement, the fixed income market is just wildly different than what it was 5 years ago. And I think it's for the better. Like investors can invest way differently. And then there's the whole advent of, not even the advent, just like how does crypto fit in portfolio? How does
Mhm.
alternative investors? Um, what if everyone can invest in private equity? What does that do to the markets, right? Um, what if Trump turns, what if Trump's, every 6 months, like what if that happens? Like then our markets are going to be, um, they're not going to, they're going to be more private just by that fact, right? Um, yeah, it's a great time to be an investor. More choice equals more freedom. Um, but it also is going to be challenging to stitch together portfolios into
Yeah,
the
but
future.
I also think that there's just investing is also different. I think that 2020 really, really, really changed like what a portfolio is.
Hmm.
Like if
Yeah.
you look back to like 2020 to now, like this even just stock bond correlation, it's just they're just more correlated.
Yeah.
When the stock market falls, the bond market falls. It's not like what it used to be. So there's more need for diversifying assets than there was pre 2020, where like stock bond correlations were generally like negative,
Hmm.
which is where like those private assets really start to fit in better.
Yeah. I think what's interesting about this is out of like all these, like we'll call them like liquidity booms, right? So you had the TARP deal in 2008, 2009 when the government at that time, everyone was like, "Oh my word, this is huge. This is, $1 trillion is going into the US economy." Then the next liquidity boom was in 2020. And now we are not in a government induced liquidity boom. We are in an AI fueled liquidity boom. Interesting things come out of these environments, right? Like Uber, Airbnb. There's some like generationally defined companies, and you can like to some degree, um, the cloud, like the cloud was built. The cloud was built after in the ashes of 2008, 2009, and on the backs of the cloud were all these really interesting software companies, right?
Mhm.
Now we are in like this like not this liquidity boom that's being provided by just corporations basically. And yes, governments are spending a lot of money. Palantir is a huge benefactor of this, but
Yeah.
of just government liquidity in private markets. So it'll be interesting to see where what the mark is on this like chapter of investing. But I'm excited to be investing into the future. I think it's going to be harder. It's going to be faster. People are going to have more choice, and that means there's more opportunities to make mistakes. But um, I think the backdrop is good. And
Yeah.
if we do get a soft pocket rally, because there'll be something that knocks us off, right? In like what investors have said generally is like they've got a lot of cash. And we know that because, well, we see our clients and what they have and what they want from a cash position. But then also just the fact that the money market, while all these markets have rebounded, yeah, people are still holding a bunch of cash.
Yeah. Corporations have a bunch of cash.
Yeah.
You kind of said it without saying it, but like this is like a liquidity boom that's coming from corporate profits.
Hmm.
It's not
Oh,
like a
yeah.
one-time huge injection. It's like a corporate profit liquidity boom of like Google just makes so much money, like a ridiculous amount of money. Microsoft, a ridiculous amount of money that just can be used to do whatever they want. Like investing $100 million for them is like nothing.
Yeah. Oh, literally
And
doesn't matter. Yeah.
yeah, and so like there's just a lot of liquidity in the system that isn't like being forced into the system. It's just created by the system.
Yeah.
And
I
that is
guess
ultimately really good.
where I'm getting like if there's like an ounce of like what am I concerned about? It is like it is like just take Nvidia for example. Like they had to cut a deal. They were so successful they had to cut a deal with the administration for their 15% of their revenue from China, right? Like who knows if they had to buy Intel. Like there's just a lot of um there's just becoming more and like these big companies are becoming more and more interconnected. I think by not by choice necessarily, but by necessity. Like the market's been so good and there's only so many places you can invest, as you've said, $300 billion, right? And there's only so many different times. So I think that is concerning, right? But the knock-on effect of this is that like while these companies have had a boom in liquidity from corporate profits, investors themselves have made so much money and that they themselves can reinvest in other parts of the market. And that's where I think like these like sector rotations, we've talked a lot about this in our investment committee meetings, but like the sector rotations away from big tech and into other parts of the market, that I think is that's something we will just be watching out ourselves for our clients, of course, um, heading into the end of the year and into 2026.
Yeah, and for people watching this too, like how, just to explain like how that actually works, like wealthy people end up making way more money that turn into more cash flow producing assets. Like that's if you just go back like a couple videos, like we
Mhm.
literally just explained like, yeah, if you like have money and you spend less money than you actually make, especially if you're like retired with just a bunch of assets, those that extra cash flow just gets reinvested into more cash flow producing assets, and that's how
Yeah.
people can like compound assets
Yeah,
and
yeah,
like wealth
compounds
and like yeah.
and the knock yeah, the trickle effects. And the like that sector rotation, like it happened in 2025, like it'll happen again in 2026. We don't exactly know how it's going to look, but that's I think where there's going to be some money to be made, some losses to avoid by following this, but also some money to be made. So, well, hey, we're at the 30-minute mark, so I want to cut this off here. Any parting words, Jacob?
No, all I can say is I'm curious to see how fast $1 trillion can go into AI, and I'm like we're at 400 billion so far. We'll see if there's more that rolls into it.
There we go. Well, hey, thanks everyone for tuning in to this month's edition of the Wealth Workshop. If you have any questions, leave them in the comments below. We'd love to answer them. If you're coming from the newsletter, thank you for reading. We'll put a pinned comment for our newsletter if you're not a subscriber. Thanks for your support. Thanks for your time and attention, and we'll see you guys next month.